As we move through December, there's a feeling that we're almost done with the year, but there's still plenty to play for because this coming week has a raft of rate decisions from key central banks headed up by the FOMC. So let's take a look at those decisions from the likes of the RBA, the Bank of Canada, and the Federal Reserve to gauge exactly what's in the mind of the central bankers, what the decisions are likely to be, and the potential impacts on the likes of the equity markets and the FX markets. As ever, we're going to take a look at the big picture first of all. This is the top tier releases according to Trading Economics economic calendar, kicking off on Monday with the export-import balance of trade data coming out of China, with an expectation that we see improvements across both of those metrics. Then moving into Tuesday, we see a focus on Australia because we have the RBA interest rate decision with an expectation that we keep rates steady at 3.6%. We've got trade balance data in Germany and then job openings data out of the US. That provides the precursor to the rate decision from the Federal Reserve, which happens on Wednesday, alongside a decision from the Bank of Canada. We're expecting to see the BoC keep rates steady, the Federal Reserve cut rates by 25 basis points. And alongside that, we have Chinese inflation, and on Friday, the UK's monthly GDP release. So let's kick off with a look at the US. Of course, the week just gone has seen a few data points. Of course, we didn't see the jobs release, but we have got the likes of the ADP payrolls figure that came out. And the core PCE price index, I'm releasing it before that, so I can't necessarily speak to that. But as things stand, inflation has been by and large under control. Crucially, we have got the FOMC's interest rate decision on Wednesday, with markets expecting the 25 basis point cut. And essentially, the job of the Federal Reserve is to make sure they don't see a significant uptick in terms of unemployment, but also make sure they don't see inflation sway too far away from their 2% target. Well, we've got a little bit of both here. Unemployment is on the rise, albeit from a low base. And we, of course, have the fact that inflation is close to that 3% mark. So that's also pretty elevated compared to where they want to be. And so for the Federal Reserve, it's a case of trying to gauge exactly which of those is the factor that needs addressing: weakness in the economy or elevated inflation. And by and large, it appears to be the case that they're willing to move in favor of supporting the economy at the risk of raising inflation. Now, this is the latest ADP payrolls release that we saw here. The negative 32,000 figure shocked markets. Notably within that, we saw small businesses representing 120,000 loss, with medium and large businesses actually gaining. So very sort of divergent experiences depending on the size of the business. But nonetheless, there are still problems within the US jobs market that has led people to believe we are going to see the Fed act. This is the inflation outlook. Like I said, I'm recording this before we see the core PCE price index, but while we're around that 2.9 mark for that metric, the 6-month annualized is at 2.5. Essentially, that points towards the fact that beyond January, February, we do see inflation as being largely under control and at a pace that's below where we are at the moment at the year-on-year figure. So that gives the Federal Reserve some confidence that we're not seeing short-term inflation surge, and therefore they can act a little bit ahead of time. Notably, even if they do cut rates this time around, the rate cut this time around represents a cut before a lull. I mean, look, we're not expecting anything from the January or the March rate decisions. Then you see the rate cut coming into play in April. Albeit, if you look at the breakdown for March, you can see that there's about 50% chance in either direction. So there is a possibility that we see a rate cut. But certainly the easing should slow as we move through the year. The caveat to that is, of course, we're going to see a new chair at the Federal Reserve in the midway mark of the year. And with Kevin Hassett apparently lined up for the role, there is a perception that he will be cutting rates and not forcing, but pushing the rest of the group to do the same, irrespective of whether they've just come off the back of an easing cycle, and that they may think that the neutral rate should be roughly around that 3% mark. He would undoubtedly push them to ease further. So that is a story that certainly will, in my mind, gather momentum if we see him coming into that position and replacing Jay Powell. From a market perspective, what we've been seeing here is, in terms of, say, the Nasdaq, this significant rebound. Of course, we saw that protracted period of weakness around concerns on the AI space. That has very swiftly been bought, as people tend to do as soon as they see the sign that the dip is over, essentially. They take the opportunity to be able to get in, and that has been playing out. So, at the time I was saying that I didn't see a justification for a massive collapse. We saw a pretty significant decline, drop down into essentially the 2400 support level, and we've been regaining ground since then. Do we just see a straight line move straight up through the prior peak, the prior record high, which is at 26255? Maybe not. Maybe we do see some sort of retracement. I mean, it appears to be the case we're losing traction a little bit here. So I would say just follow this on an intraday basis. This is the hourly time frame. That's probably the one to go at. I mean, it's quite easy to pick the bones through where your sort of swing lows are within this whole move. And so as long as we continue to create higher highs and higher lows, it's not a problem. But as you see here at the beginning of it, very wide swings. And then as you get further on, the upside moves are smaller and the higher lows are closer. So that means that we are seeing deeper retracements, but the trend does still remain in play. If we break through the 25372 mark, then that points towards a potential period of downside coming into play for the Nasdaq. But in my mind, look, you're looking at a market that is heavily trending towards the upside. I wouldn't be surprised to see a return to record highs before too long, but it certainly feels like we're flagging a little bit in terms of momentum. I would say maybe stochastic or RSI. Let's get the RSI up on this occasion. Look at it on, say, the daily. It's an interesting one. I mean, you're seeing this sort of bearish divergence where you're seeing lower highs in play here. So the possibility of another lower high, whereas we have been seeing higher highs in price action. So do we see that bearish divergence ultimately play out? We see the RSI rolling over and we see price action rolling over from a lower high. Possibly. I mean, I wouldn't necessarily utilize divergences as the key signal to be able to take a trade on. But as we're looking at momentum, you can see it is starting to roll over a bit at the moment. But, we can continue in this vein. And the key thing for that is to continue to break up into new highs within this trend and not break the price swing low. So keep a close eye out on that for the week ahead. Next up, what we have is a view on Australia. Now, we've got the RBA interest rate decision taking place on Tuesday morning. Markets predict rates to remain steady at 3.6%. Notably, what we have seen recently is relatively strong economy, better figures in terms of the GDP numbers, but then also a rise in terms of inflation. You can see that here, that latest surge in terms of inflation with the 1% quarterly metric really starting to raise concerns for many that we need to see the RBA take their foot off the gas when it comes to easing. Alongside that, we've seen strength in terms of capex spending, a surge coming into play, helping lift GDP. GDP over the year, 2.1%. So an annual rate of 2.1% is pretty healthy, really. It points towards the RBA potentially having to focus a little bit more on keeping a lid on inflation after that latest rise. So a more hesitant outlook from the RBA. What does that do in terms of monetary policy? It points towards markets just thinking that we're not going to see anything. You can see that here in terms of market predictions, according to the Icon platform. They're pretty much not pricing any cuts from here on in. And the chances really are more geared towards a hike before too long or within 2026. That provides the basis for potential strength. One of the pairs that I often like to look at for such kind of things is the Australian dollar against the New Zealand dollar. Now, let me just maximize that. What's notable here is we've seen a bit of a pullback in play here. This is the weekly time frame. So we've got this strong move towards the upside. The recent pullback comes into an ABC style retracement, which is often how I like to see those retracements, sort of Elliott wave style moves. And then we've got, let's get the 61.8 on here as well. So we've come into this sort of deep fib zone. We're starting to move higher once again from here. Essentially, if we break the 112,775, that's when all bets are off and it looks like we could start to roll over. Until then, there's a good chance that we are going to see a bullish continuation coming into play here. Let's just see if we've got sort of trendline support here. So not from that. I would say maybe the easiest way is to draw it in the opposite direction. Yeah, I mean, you could maybe start looking at inside trend lines, but it's not particularly convincing. So irrespective of that, ultimately, you're looking at a pullback within a strong period. The idea that the RBA are essentially done means that we could see further upside coming into play here around this meeting. We have been regaining some ground. Of course, there is the caution that it could be another retracement before the bears come back into play. So certainly greater confidence comes with a rise through 1157. But nonetheless, we do have a bullish trend, and that points towards this latest pullback being a likely retracement before the bulls come back into play once again. And finally, let's look at the Canadian region. Of course, we have the jobs report for the week just gone. Again, I'm recording this before that jobs report. But nonetheless, the outlook here is that we see rates steady at 225, significantly lower than the RBA. We also see inflation released. Oh, that is the following week that I've accidentally put in here. No wonder they don't have any forecasts. I wonder why not. Okay, so we don't see that this week. We see that next week. Nonetheless, unemployment is on the rise in Canada. So clearly they feel the need to be able to help where possible, but they already have had a significant bout of easing. And part of the problem here is that whilst inflation on the headline basis isn't that far from the 2% target, the core reading certainly is elevated, closer to that 3% mark. That points towards the Bank of Canada potentially needing to hold off before too long, especially given the easing that they have already done. In terms of market pricing, you can see here, basically markets don't expect anything. They think that we're going to see more of the same. They're not going to hike because the economy doesn't have it in it to withstand it. But I think that the Bank of Canada has already pretty much done everything it's going to do, and therefore it's 2.25 for a while on from here. That provides the basis of potential upside for the Canadian dollar against currencies that are seeing rate cuts coming into the fold. I wanted to take a look at the US dollar against the Canadian dollar for that reason. Of course, we have been seeing this period of strength over much of the past year. However, you know, well, certainly the past sort of six months, that gain does start coming into question recently, given this breakthrough neckline support that we've got at 1397. That break points towards this sort of double top formation and the possibility of a bearish phase coming into play from here. Here's the 4-hour chart. It's just a case of looking at this on a sort of intraday basis. You can see here the swing high at 1.401 essentially. We've rallied, immediately flush lower and hit into a new low. So more of the same, I think, is expected. I think that this market is likely to have topped out. And certainly if you're looking at a country out of the two that's going to be easing further, it's going to be the Federal Reserve. Markets expect another 3 rate cuts from the Fed, including the upcoming one in the week ahead. However, I would say the caveat to that is we still haven't got the new Fed chair in play. And if we see someone like Kevin Hassett in there, very unlikely he's just going to sit in the role and say, okay, fine, we don't need any rate cuts. He's going to be pushing hard, and that could mean a bout of dollar weakness for the year ahead. So to the downside, keep an eye out for this 1388 support level, that if we break that, it really furthers the moves that we've seen with this double top formation that has completed of late. So yeah, dollar CAD, an interesting one to watch in a week that's really going to be dominated by central banks. We've also got the SMB with their interest rate decision as well in the week. Other than that, make sure to like, subscribe, follow for more content like this. I hope it's been useful. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading.